Since our last analysis, Union Ministry for Food and Consumer Affairs has announced a significant revision to open market sales scheme policy for 2024-25. As per the revised scheme, the reserve price of rice has been fixed at 2,250 rupees per quintal for the production of ethanol. This revision was a much needed support to the ethanol industry. Now, coming to the company's third quarter performance, manufacturing segment performed poorly due to high raw material prices, with margins coming at 1% or 85 paisa per liter. The company had to reduce the capacity utilization to 50%. Currently, almost 80 to 90% of the ethanol is produced from maize and all of ENA is produced from rice. In the consumer segment, the regular and the others posted the highest ever quarterly sales of 4.08 million cases with 11% year-on-year growth in sales volume. In the prestige segment, the company posted a year-on-year growth of 155% and is on track to exceed the company's revenue target of 100 crores. The company has also reduced EBITDA losses in this segment. What can we expect from quarter 4 results? Q4 is expected to be muted as FCI has not started supply of rice at the revised prices as of February 12, 2025 on the date of company's concall, and the company expects to see commencement of supply by the end of February. Also, the company has plans for a planned shutdown of West Bengal distillery for 3 weeks for overhaul and commissioning of corn oil plant. The company, however, mentioned that there is some softening in maize prices since the announcement of supply of rice from FCI. Please note that Indian maize prices and international corn prices doesn't align perfectly due to very high import duty imposed on corn. Revenue from consumer segment is usually muted in quarter 4 as is visible from the last 2 years due to excise license changes in April. The company's margins in the consumer segment may improve due to softening of rice prices and 100% of ENA production is from broken rice. From next year, the margins may improve for the manufacturing segment as raw material prices are expected to drop as rabi maize is expected to be harvested from April to May and rice is also forecasted to have a better crop as explained in our previous analysis. Even though in limited quantity, FCI's supply of rice will also aid margins. And the company expects EBITDA margins to trend towards 5 to 7 rupees per liter in the long term. Also, any trade deal with US reducing import duty on corn may reduce prices further. In the consumer segment, the reduction in broken rice's prices will aid margins and company's foray into UP's regular and other segment is a major monitorable. As discussed in the previous analysis, UP is a 100 million case market. And to put things further in perspective, Bundy Bubbly, a India Glycols Limited country liquor brand, recorded a sale of 17 million cases last year. So even a 1% market share gain would be significant for the company. Globus has recorded a sale of 13,000 cases in Q3. The margins will be lower in UP until the distillery in UP commences operations, which is expected to be completed by second quarter of 2026. Currently, 80 to 85% of regular and other segment is contributed by Rajasthan, and the price hike of 4.35% company received from Rajasthan from April 1st will add to margins in consumer segment. In the prestige segment, the company entered the quarter on a very positive note, and we may see a few states breaking even at EBITDA level this year, further reducing losses in this segment. Also, Terai and Doab has won awards at Berlin International Spirits Competition 2025. It could be promotional to a certain extent. Any reduction in ethanol procurement prices due to fall in crude oil prices would be a key risk. Secondly, removal of incentive on production of ethanol from maize could be a risk as well. In conclusion, Globus Spirits seems to be in a good spot for the next year and is largely insulated from the current tariff issue. However, a key risk would be reduction in ethanol procurement prices if the crude oil price falls significantly due to the tariff wars. The company may significantly benefit from softening raw materials price hike for the consumer segment and reducing losses for the prestige segment.